What up guys, Mina the Money Goddess here, and it's tax season. So what better thing to talk about than tax deductions? Let's go. Welcome back guys, Mina the Money Goddess here, and it's tax season. Yeah, so let's look and see if you're taking the most tax deductions possible. Here are my top 10 tax deductions for you. All right guys, number one on the list, super common. The standard tax deduction for the year of 2020 is $12,400. Double that if you're married filing jointly, which would be $24,800. Or if you're head of household, it would be $18,650. Very common. Just make sure you're taking advantage of that. If you are itemizing your tax return, whole other gambit, probably a whole other YouTube video, but very common. Just make sure you're utilizing this method. Number two is business expenses. So if you are self-employed or have a side hustle, you are able to write off quite a few things, business expenses off of your taxes. So it could be mileage, it could be advertising, marketing, a home office. There are many things that you can write off. Please do a little research. I would have to make an entire other video on this alone, but very common again, business expenses. Number three, make sure you are making the most of your company's retirement account. So a 401k, a 403b7, or a 457. All of these for the year of 2020, you can contribute up to $19,500. I know that's quite a bit of money, but if you can sock away some money, please do so. This is wrapped into your W-2, so it reduces your taxable income. Definitely take advantage of this option. If you are self-employed, here are a couple options for you guys. You can deduct even more, up to $57,000 off of your SEP IRA, simple IRA, or a solo 401k. So there are stipulations in and around this. So it's typically 25% of your business income or $57,000, whichever is less. But please seek a CPA on all of this. Here are the parameters. Be sure you are contributing to retirement accounts. Number four, backdoor Roth or mega backdoor Roth. Now, before I hear from the peanut gallery that you cannot take a tax deduction on a Roth contribution, I'm well aware. However, I want to point out that over time, the tax advantages of a Roth clearly are advantageous. So if you earn too much money, there's income stipulation to how much money you can earn and also fund a Roth. So let's go over a backdoor Roth and a mega backdoor Roth for your entertainment and consideration. So I'm sure you've probably heard by now that you can contribute $6,000 into a Roth IRA. You do not get a tax deduction, $7,000 for the year of 2020 if you are over the age of 50. But you cannot contribute to a Roth if you earn $124,000 if you're single filer, or $198,000 if you're married. So how can we get money into a Roth IRA if you earn over these dollar amounts? Well, they are called a backdoor Roth and a mega backdoor Roth. Okay, so let's go over the backdoor Roth first. It's pretty simple. Open a traditional IRA, contribute $6,000 for the year of 2020, or $7,000 if you are over the age of 50. Okay. Now, the next day, or the same day if possible, convert the monies from your IRA into a Roth IRA, and boom, you've got your money into a Roth, ready to go, ready to grow tax-free till you're 59 and a half, or even thereafter too. Anyhow, back to a Roth. For the mega backdoor Roth, we're going to do the same thing. We are going to take $19,500 and put it into our 401k, 403b, or 457. If you are self-employed, you're going to take your $57,000 up to $57,000 and you are going to contribute that to your SEP IRA or your solo 401k, and then you are going to take those monies and convert them into a Roth. Boom, that's why it's called a mega backdoor Roth. A couple of caveats to this backdoor Roth solution. Please seek a CPA's advice and help, because not all 401ks allow for this. Also, if you have money in a SEP, simple, traditional IRA, 401k, sometimes the IRS doesn't allow for all of the conversion. Sometimes they penalize you if you leave any money behind. It's a whole thing. So please see a CPA and make sure that it is applicable for your situation. There's also another tax form that you have to fill out. So yeah, that can be a lot of fun. You might as well pay for good legal and tax advice, please. Number 5 is a health savings account, an HSA account. How to open one is to smash that subscribe button below. No, in all seriousness, I did put links down below, and this is very serious because the number one reason for bankruptcy in the United States is because of medical bills. So I find this one very important for everyone. So again, please look at the links below, how to open an HSA account. There's a couple of caveats. It has to be used in conjunction with a high deductible health plan. So make sure that your health plan is applicable and that you can use an HSA account with this. Also, you need to know that there are no income limits, so it doesn't matter how much money you make, everyone can have an HSA account. Also, you need to know that you can take a tax deduction. If you are single for the year of 2020, you can take $3,500 off your taxes. If you are married, $7,000 off your taxes. And if you are over the age of 50, add $1,000 to these numbers. Again, click the links below. Click the subscribe button below and open yourself an HSA account. All right, guys, number 6 is student loan interest deduction. So I know a lot of the student loan programs have frozen interest charges at the moment. However, you're going to need to know this eventually. $2,500 if you are a single filer and $5,000 if you are married. Those are the deduction limits that you can take off of your taxes if you are paying student loan interest. Number 7 is gifting. So for the tax year of 2020, you can gift up to $15,000 per person if you're single, or $30,000 if you're married. So let's go over a quick example. Let's pretend I have 3 kids and I'm a single parent. I can gift each child $15,000, $15,000, $15,000, so $45,000 total in gifting, which I can deduct off of my taxable income. So that's a really great gift to them for their college education one day. You can put these into a UTMA or a 529 plan. Now, let's talk about if you are married. This number doubles, $30,000. So if you're married and you have 3 kids, let's pretend I have 3 children and I'm married. Now, my spouse and I can deduct up to $30,000 per child. So now the number's up to 90. 3 times $30,000 is $90,000. $30,000 to each child for college. Again, you can put these into a UTMA, a Uniform Transfer to Minors account, or a 529, which is a great college savings account. Those vary by state, so please look all of that up. But number 7, gifting. Number 8, charitable giving. So it used to be that the IRS wanted you to itemize your return in order to take advantage of charitable gifts, but thank goodness they've allowed everyone to deduct their contributions to charity. So please contribute to your favorite charity and take the tax deduction. Okay, realized losses or tax loss selling. So if you have a realized loss in your brokerage account, retirement accounts typically don't apply. typically. So if you have a realized loss for the year of 2020, you can take up to $3,000 off of your taxes for a realized loss. You can also carry that forward. I want to say it's up to $60,000. Don't quote me on that. Check with a CPA. But again, $3,000 off of your taxable income if you have a realized loss, and you can carry that forward into many years. So a quick example, if you have a $10,000 realized loss on a security, a stock, usually, in your brokerage account, you can take $3,000 for the year 2020, $3,000 for the year 2021, $3,000 for the year of 2022, and $1,000 for the year of 2023. So again, tax loss selling, tax loss harvesting. Number 10, we made it. 1031 exchanges. So if you have a real estate property, an investment property, and let's pretend it's a condo, you have a condo, you sell it, you make money on it, but if you buy a like property within a certain time stipulation, you can circumvent those capital gains taxes. It's called a 1031 exchange. So this is how the rich keep getting richer. Now you know, 1031 exchange. Thanks so much for staying till the end, but I have a bonus for you for sticking around. All right, bonus time. All right, you wanna know how to reduce your taxable income? Let me be frank with you. Quit your job. That's right, I said it, quit your job. I'm kidding with you. Do not quit your job. That would reduce your taxable income, however. But this is for people in states with high income taxes. So California is on the top of my list. So if you reside in California, you can buy tax exempt bonds, California muni bonds, and now you don't have to pay the state income tax nor federal income taxes on municipal bonds. So the bonus round would be tax exempt muni bonds. So I hope this was helpful to everyone. Again, smash the subscribe button, the like button, leave a comment for me below. Thank you so much for sticking around.